Hey everyone, and welcome to this explainer. Today, we're taking a massively complex system and making it crystal clear for you. We are going to unpack a truly fascinating piece of human history that completely transformed the very nature of what money actually is. We're looking at the architecture of trust and the incredible evolution of banking institutions.
Let me hook you right off the bat with a question. Is your money actually sitting in the bank right now? Seriously, think about it. Most of us naturally picture our savings sitting neatly stacked up in a giant secure vault somewhere, just waiting for us to swing by and ask for it. But to really grasp how our global economy works, we kind of need to toss that image out the window. Money is not a static object sitting in a dark room. It's a dynamic, flowing energy.
Section 1, From Passive to Active Wealth. Okay, let's dive into this. To understand how that flow of energy started, we first have to look at the historical problem of idle, wasted wealth. For centuries, this literally held human progress back, because for the vast majority of history, money was just a passive store of value. Just imagine a heavy wooden chest of gold coins gathering dust in a basement. Sure, it kept its value, but it wasn't actually doing anything. Well, the emergence of banking introduced organized intermediation. It basically played matchmaker, connecting the folks who had surplus resources with the folks who desperately needed capital. And just like that, we get active wealth. That dusty gold was suddenly flowing like a river, building ships, funding massive new trade routes, and constructing bridges. It laid the entire foundation for modern finance by turning money into an active, working tool for economic growth.
Section 2. The early roots of banking. So how did humanity actually figure this out? If you view this evolution as a series of brilliant human solutions to economic bottlenecks, the history just totally comes alive. We start way back in ancient Mesopotamia, right around 2000 BCE. Get this, temples and palaces actually functioned as the world's very first financial centers. They were recording loans of silver and green on basic clay tablets. Then, by 1754 BCE, we see this massive leap. The Code of Hammurabi stepped in and provided an actual legal framework to regulate interest rates and loan repayment. Fast forward a bit to the medieval era, and global trade is getting incredibly complex. To handle all that friction, merchant banks emerged. Over in Italian city-states like Florence, heavy-hitter families like the Medici built these highly sophisticated networks. They managed deposits and issued credit, while literally sitting at wooden benches called bancos right out in bustling public plazas. And at the exact same time, the Islamic world was developing brilliant partnership arrangements and credit instruments, proving that these core banking concepts could adapt beautifully to entirely different cultural and legal frameworks.
Section 3, The Intermediation Engine. All right, now that we've got the historical context down, let's look at the mechanics. I want you to think of banking like an engine that processes the flow of wealth. The fundamental economic logic here is just the efficient use of resources. Because at any given moment, somebody has extra funds they don't immediately need, and somebody else desperately requires capital to, say, start a farm or fund a trade mission. Banks bridge that gap through 3 core steps. Step 1 is the deposit. You place your money for safekeeping, fully expecting you can get it back later. Step 2 is lending. The bank channels those previously idle funds right into productive activities. And step 3 is interest. This is the crucial fuel for the whole engine. It's the price the borrower has to pay, and it's the necessary reward for the saver. So the big takeaway here is that this specific cycle ensures money never just sits around. It's constantly out there working, generating brand new goods and services.
Section 4. The fractional reserve multiplier.
Now, if those previous mechanics were the basic engine, what we're talking about next is the supercharged solution invented by early goldsmiths, and it absolutely changed the global economy forever. We're talking about the fractional reserve system. This is the practice of lending out a large portion of deposits while keeping only a tiny fraction in reserve. The backstory here is just fascinating. Back in the 17th century, people would drop off their physical gold with local goldsmiths for safekeeping. But these goldsmiths noticed a highly predictable pattern in human behavior. Their customers almost never came back to withdraw all their gold at exactly the same time. Once they realized this, it was a total game changer. They started lending out paper certificates for way more gold than they actually had sitting in the vault, knowing for a fact they only needed a small fraction on hand for routine daily withdrawals. And this brilliantly illustrates the multiplier effect that was born from that goldsmith realization. Let's look at the math. Imagine an initial deposit of 1,000 units. If the bank keeps a 10% reserve, they hold on to 100 units and they lend out 900. right? But that 900 doesn't just disappear into thin air. It gets spent, and then it gets deposited right back into another bank. So that second bank receives the 900 deposit, holds 10% in reserve, which is 90 units, and lends out 810. This process just loops over and over again. This multiplier effect is exactly what supports a massive, mind-boggling volume of economic activity that goes far, far beyond the strict limits of whatever physical currency we actually have printed. But looking at that math, a pretty terrifying question should be popping into your head right about now. What happens if literally everyone wants their money at once? If the system only holds a tiny fraction of the actual cash, what happens when panic strikes? Well, that introduces the inherent structural fragility of the entire banking system.
Section 5, Trust, Risk, and Regulation.
To address that very real fear, we had to design modern solutions to protect the system from the absolute disaster of a bank run. You see, the exact structural risk that causes a bank run when panic sets in is called maturity transformation. It sounds complex, but it's simple. Banks take short-term deposits, like the money you think you can withdraw from an ATM at 3 in the afternoon on a whim, and they turn them into long-term loans, like a 30-year mortgage for someone's house. Because the bank transformed the maturity of that money, they simply do not have the physical cash on hand if the entire town shows up demanding their deposits on a random Tuesday morning. So, to manage this incredible fragility, modern societies had to invent some incredibly robust safety nets. Following the devastating bank failures of the Great Depression, the United States established the FDIC in 1933. Their job? To legally guarantee your deposits. And that creates trust. Furthermore, today we have central banks. They act as lenders of last resort, which basically means they step in to provide emergency liquidity to banks the second a panic starts to brew. Honestly, these regulatory institutions are the only reason a temporary money shortage doesn't immediately spiral into a total systemic economic collapse. Which brings us full circle to our conclusion today. As this quote beautifully states, modern banking is a trust-based architecture. Money is trust. Think about how far we've come. We moved from simple moneylenders tracking grain on ancient clay tablets to this vast, complex, global foundation of stability. And it isn't sustained by shiny physical gold sitting in a vault anymore. It is sustained by a highly balanced ecosystem of risk management, regulation, and leveraging predictable human behavior. So the next time you tap your card at a coffee shop or check your bank app, I really want you to ask yourself, are you looking at physical wealth or are you simply looking at a digitized measure of human trust? Thank you so much for watching this explainer, and as always, keep questioning the systems around you.